Good morning, good morning, good morning. Happy Tuesday, everyone. Happy Tuesday. Well, first of all, let me just say I'm super excited because I'm trying to be consistent on being live on Facebook, Regina, the Queen of Carlone's page, and actually YouTube. So if you're stopping by my YouTube page and you're new or you're new to my channel, do me a favor and subscribe to my channel. If you are new to my Facebook page, Regina, the Queen of Carlone's, please give me a like, make comments in about my video because I'm looking to go live every Tuesday from 7:30 a.m. between 7:30 a.m. and 7:45 to about 8:15, sometime 8:10. Just looking to get into the grind of sharing information. If anybody's been following me for, I don't know, maybe the last maybe 7 years, you guys know that I look at I'm trying to be consistent with sharing information, sharing knowledge on things that I have learned and with my customers and just information I've shared actually across the country to make you a better stewardess when it comes to buying a car, whether it's leasing, buying, um, credit, just sharing information. So I got with my producer, Sante, about, I don't know, we've been talking about it on it for the last 6 months. And we decided to start this podcast. And this podcast is for me to just to share information, looking to you and engage and just sharing information that I believe people are looking for like yourself. So let's go ahead and dive into today's topic. When I came in with today's topic, involuntary repossessions in 2025, I thought about the Great Recession in 2008 when the automobile industry it was a notable rise in involuntary repossessions rates. And it started back in 2025. But if anybody remember the 2008 is when Obama got in office and I actually was in I was actually in the mortgage business. I was a mortgage broker, and the name of the company I was working for was called Mortgage Institute of Michigan. And I was in the car business starting in 1998. I'm going way back, but I went to the mortgage business for a few years, and I figured that the mortgage business was going to go first. It was going to take a dive before actually the automobile industry did, and it went vice versa. The automobile industry went first and then the mortgage business. The automobile business in 2008, um, I remember you can go into a dealership, you can probably get anything you want. It wasn't so much based on a credit score, it was based on job time. I started off at working at Arbor Pontiac located on Updike, that's no longer there. But it was a single point store, which was a Pontiac store. And anybody from Pontiac knows that we are a General Motors town, or Michigan is a General Motors town. And at that time, individuals would walk into the dealership, and it was really based on their job time and how much money they made. So if you actually went in to get a car, it wasn't about your 500 credit score or your 480 credit score or your 500 credit score. If you were hourly employee, you got paid weekly. So General Motors, when they look to give you a car, they call it payroll deduct. They would take your car payment out of your paycheck. If you hourly, they took it out every week, and then they got their money before you got your money. So if you had a $500 car payment, and you would make the option, you would have the option of taking it out weekly or every 2 weeks. As long as they got their money, it did not matter. So basically, everybody was happy with this because due to the fact is, I don't even have to pay my car payment. It's coming right out my check. So customers or people really didn't worry about um, paying a car payment because it's already paid before they got their check. And back in the day, 2008, 2007, it wasn't a lot of people that worked for General Motors that were homeowners. They were renting because you know what? The only thing they were worried about is having a nice car. And having a nice car was not based on credit. It was based on where you worked, job time, and how much money you make. So reeling it back into 2025, um, repossession rates have increased. Overall repossession volume predictions vary, but it's estimated that um, repossession has gone up to 1.8 million vehicles, or even slightly higher in 2025. What does this mean? It's going all the way back to the Great Recession of 2008. And the reason I say during Obama days is because if it wasn't for Barack Obama in 2008, the big three would not be around. Ford was the only company that actually did not file bankruptcy, but General Motors and Chrysler filed bankruptcy. So we were protected. When I say we were protected, because it was a plan to help us still be able to sell cars, and also individuals that worked for General Motors and Chrysler were still able to maintain their jobs. It was just about doing a little bit of cutting of the pie, making things happen where they can still stay in business, but cutting back. I remember the time where they made it where if you start off at General Motors, people were starting off at $22, $25 an hour. But they made it where it was contracted, or it was contracted with a company where people that started at General Motors, they're starting off at $12, $13 an hour, $14 an hour, between $12 to $15 an hour. Now, this saved General Motors millions of dollars during this time. And the reason it saved millions of dollars during this time, because you didn't pop in and start making $22, $23 an hour. You started making $12, $13, $14 an hour. And you didn't get those perks that anybody that started off at General Motors making. Right now, people that are working at Ford or Chrysler, they're actually, if they've been there 15 years or 20 years, they're at 35, 36,000 an hour. They're working 40 hours a week. And now Chrysler, General Motors hasn't adapted this philosophy, but Chrysler, if you're working 3 months for them and some other things that you have to actually qualify for, they'll give you a car. They don't care about your credit, but you have to have so many hours and the other things that you have to qualify for. But you'll end up getting to drive a brand new car from Chrysler. 3 months on the job, or so many hours. But anyway, let's go ahead and dive into today's program. Now, delinquency rates, auto loan delinquencies, have surpassed the 2005 recession, and which means that during the Great Recession around quarter one in 2000, during the Great Recession, as of quarter one 2025, almost 5% of auto loans were delinquent. Now, what you're gonna say, Regina, what does this mean? This means that a lot of the subprime borrowers, those with credit scores between 580 and 619, were experiencing particularly high rate of delinquencies, with nearly 6.56 being at least 60 days overdue on their loans in January 2025. What does this mean? Is that customers that between the credit score of 580 and 619 were delinquent for 2 months, and they didn't know how to catch up. Last week's show, I talked about ways to actually, before you get into the repossession category, what do you do? So I kind of did it backwards. I should have started off talking about numbers and trends, but I went in last week talking about what do you do before you get into the repossession part? What do you do? How do you get from being 60 days or 30 days late? What things do you do to get back in the driver's seat? Well, prime borrowers with prime borrowers, while subprime borrowers are where the most impacted. Prime borrowers are those with stronger credit scores. We're also seeing an increase in delinquencies. So this means that in January 2005, there was 0.39% up for the prior year when it came to delinquency, when it comes to prime borrowers. Now you're saying, Regina, what are prime borrowers? Now, prime borrowers, people that buy in cars with 620 credit scores or higher. Now, people always say, what factors actually help with this trend? So this was lingering effects of previous lending practices, looser lending standards during the pandemic, which was in 2008. It particularly for subprime borrowers result in longer terms, higher interest rates, And a lot of things what I see customers when they look at their contract, that you have your interest rate, you got your payment, and then you got if you keep your car the 5 years, the 6 years, how much you actually pay for that car. And when I when I look at a contract, I take a contract as a credit card statement. Credit card statement, they always tell you if you keep your credit card, if it takes you 3 years to pay your credit card off, this is how much you're going to pay. Only thing on a contract, what they do is on an automobile contract, they tell you over the life of the loan. If you keep it for this many years, if you have a 5-year contract or a 6-year contract, this is what you're going to pay. So you might ended up paying 22,000 for that car. By the time you pay it off, you're going to pay double. You're going to be at about 38 or $40,000. Why? It's because interest. The higher interest rate, the more money you're going to pay for your car. Let me say it again. The higher your interest rate, the more money that you're going to pay for your car. We're going to go ahead and go to slide 2. So now I want to talk about repossessions in Michigan. A lot of people, repossessions happen in other states, but I want to really dive into Michigan because I'm in Michigan. I work at Joe Longhammer Chevrolet in Waterford, Michigan. But here's a breakdown of how Michigan is. Michigan is a self-help repossession state, meaning a lender can repossess your vehicle as soon as you in default on your loan without even a court order. Now, some states you have to go to court to actually to have your loan or have your car repossessed. In Michigan, you don't have to do that. Your lender does not have to do. Let me say, if it's Santander, they don't have to go to court and say, you know what, you haven't made your payments on time. I need to get a court order to get you to repossess your vehicle. But in Michigan, it's a self-help repossession state, meaning a lender can repossess your vehicle at any time. Meaning that here's a breakdown of the key aspects that what happens. Valid lien. Before repossessing your vehicle, the lender must have a valid lien filed against your vehicle, including the identification number, which is your VIN, which is the VIN number of your car, and it must have your lender's name and interest. When you buy your car, on your insurance, or you lease or buy a car on your insurance, the lien holder name has to go on your lien holder on your insurance. If you're leasing a car through GM Financial, a car has to go on your insurance. Why? Is because if you stop making your payments on your vehicle, then the insurance company knows that vehicle belongs to a car leasing, which is GM Financial. So if you are through Santander, and let's see, Chase Bank, that name is going to go on your insurance. But if you're buying your car, you're financing your car on the title, GM Financial is going to be on the title. Chase Bank or Capital One, whoever your lien holder is going to be on your title. So that's a lender's name and interest. Once you pay off your vehicle and the vehicle is free and clear, then you get a release of lien and your title is free and clear. So nobody can repossess your car after you pay it off. But so number 2, no breach of peace. Repossession must occur without breaching the peace, which means that they can't harass you and threaten you just to take your car. Now, its prohibited actions include they can't use physical force or threats to take your car. For instance, the repo man can't show up at your door or show up at your job and harass you and say, you know what, let me have your keys because I'm here to repossess your car. They can't do that. That's why they come with another set of keys to actually take your car or hook your car up on the tow truck. They're not going to knock on your door, or they're not going to come to your job and say, oh, I'm here to repossess your car. That's not what they do. So also, they can't unlawfully enter into closed structures like a home or garage. So if your car is in a garage, they can't break into your garage and take your car. Your car is not going to be in your home, so they're not going to be able to do that. But they cannot break into your garage or break your window and take your car. They also can't misrepresenting identity or intentions. They can't say there's somebody else and try to take your car. They also cannot damaging your property. Also, they can't do that. Now, they can't use police intervention without a warrant. So basically, they can't call the police and say, you know what? Stacy hasn't made her car payment. I need to have I need to have her vehicle repossessed. They can't do that. They can't get with the police and have the police intervene with taking your car. Now, if the consumer, which is yourself, objects and asks the repo company to leave, continued repossession may constitute a breach of peace. Meaning that if you ask the repo company to leave, they actually have to leave. Most of them are not going to ask you to leave, they're just going to take your car. Post repossession notice. Let's go ahead to slide 3. So the lender must provide notice of repossession and the possibility of getting the car back. This includes information about outstanding balance, the deadline to redeem, and how to redeem or reinstate the loan. Now, customers tell me all the time, I just got my car taken for one day and I got it back 24 hours later. Well, listen, as soon as they repossess your car, it's going on your credit report. There's no such thing as, oh, I just got it back 24 hours later. They shouldn't have put it on my credit report. Well, guess what? If they take your car, they already started the delinquency process. You're 30 days late, it's going on your credit report. If 60 days late, it's on your report. If it's repossessed, it's going to say repo. And then or if you get it back, redeem repo, which means you got your vehicle back. Now, let's talk about the redemption period, because this is important because people don't understand they have a certain period of time to get your vehicle back. Let me just say this. Tick tock, tick tock, tick tock, tick tock. So what does tick tock mean? Tick tock means you have 15-day redemption period following when you're repossessed. So if your vehicle is repossessed on Tuesday, count 15 days back. 15 days allows you to get your vehicle back. Now you may reclaim your vehicle by paying the outstanding debt, associated costs before the lender can sell it. Which meaning, if they tell you, if your car payment is $600 a month, and they tell you, you're 2 months late, that's $1,200, right? You got your late fees, you got your tow truck fees. They had to pay a company to actually get your vehicle, right? Not to get your vehicle, but to repo your vehicle. You're going to pay that. So whatever that amount is, you have to pay that money before you get your vehicle back, or they'll sell your vehicle. Now, deficiency balance. Now, if you choose not to get your vehicle back, there is a deficiency balance. And deficiency balance is if the sale price does not cover the outstanding loan and repossession costs, the borrower may be responsible deficiency balance. The lender can sue you for deficiency judgment to collect the balance. Give you an example. Say you owe $20,000 on your car. I'm gonna do real quick numbers. You owe $20,000 on your car, and they sell your car for $15,000, and $15,000 they were only able to get for your car. So $5,000 you owe them, but you're probably saying, you know what? I really, honestly, only owe them $17,000. Well, maybe it was $3,000 that the repo company charged to repossess your vehicle, and all the other charges that they have in there. You owe them $20,000. They sell it $15,000. They're going to send you a bill for $5,000. It's called a deficiency balance. Are you expected to pay it? Yes. Is it going to hurt your credit if you don't pay it? Yes. And if you do pay it, is it still going to hurt your credit? Yes. You're not in a win-win situation. You're in a losing situation regardless. But with deficiency judgment, they can come after you. They can go to the courts. They can garnish your paycheck and take their money. So, yeah, that is an issue. Why is it an issue? Because it's going to be a charge-off on your credit report for a vehicle. Even if you get the vehicle back the next day, that's still going to be a repo on your credit report. Now, voluntary repossession. If you choose to voluntarily return the vehicle you can't afford, that's when you give your car back. So I'm not going to go into the 4th page of this, because I know last week I talked about some ways where what you can do actually if your car is well, what to do if you're 2 or 3 months behind in your car payment. This week, just wanted to kind of talk about deficiency balance is because a lot of people don't understand what are your options if your car is repoed. Getting it back, how much time you have to get it back, and a lot of people are confused about that. What time frame do I have to get my car back? But if you are following me on YouTube, subscribe to my channel. If you are on Regina the Queen of Car Loans, follow me on my page. And then also, if you want to get a copy of my ebook, which is free, it's badcreditbook.com. Badcreditbook.com. Get a free copy of my ebook. I'm walking you through the process of buying a car with bad credit. I used to say bruised credit, but with bad credit. So badcreditbook.com. Take your phone if you're watching during the broadcast, scan it, get a free copy. It's in English and it's in Spanish. You can read it or you can listen to it in your car. And the great thing about listening to it in your car, you could be jogging, working out. You could be in the house listening to it. It's just more ways to grab information and get it into your brain. So see you next time, same place on. Did I name my podcast yet? You are horrible, Santi. You see, the queen just popping up, just trying to be consistent. Work with me. Work with the queen. All right, I'll see you guys same time next week.